Welcome to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Signe Lundholt.
And today we're really excited to analyze Warren Buffett's annual letter that just came out with the 2022 annual report at the end of February this year. And usually Warren Buffett writes a letter, sometimes very long, and in recent years it's become a little bit shorter. But he's among some of the few CEOs that writes a very thoughtful annual letter to the shareholders and to all of the stakeholders involved in the Berkshire community. And it's such a privilege for us to be able to learn Warren Buffett's wisdom from all of his experience at Berkshire Hathaway. And so the 2022 letter that came out at the end of February 2023 is discussing all of what happened in the business last year in 2022. So sometimes people call it the 2023 letter because it comes out in February this year, but that's a little bit incorrect. So I just want to make sure folks know that it's the 2022 letter that just came out and that we're going to be talking about today.
Yeah, exactly. And if you are a beginner investor, I really encourage you to read this letter. As Michelle mentioned, Buffett writes a letter every year, but this one is particularly good for beginners because it's clear and concise. In some years, the letters have been more difficult to read for beginners. For example, some letters have advanced lingo. But if you're curious and want to read one of these annual letters, then I definitely suggest that you start with this one, the 2022 letter.
Yeah, and like Signe said, it opens up very smoothly. Like it doesn't scare you with any, tricky numbers and complicated accounting terms that, might scare off some people if they open up a letter and then they're just hit with that. Because the interesting thing is in this letter and also the previous year in 2021, Buffett started it in a little bit of a different way than he had in the past, because back in the 2020 and 2019 letters, he used to open it with things like Berkshire earned however many billions of dollars according to the generally accepted accounting principles. So that's what he did for years and years. But in the letter before and this one, he said something to the effect of, we, Charlie Munger, his longtime partner, have the job of managing your savings. And this year he changed it up a little bit in saying more like, we have the job of managing the savings of a great number of individuals. So it's interesting that he changed it. Instead of saying you, he referred to the shareholders kind of like in third person, like as individuals, which seems a little bit different.
Yeah, and I also noticed that he empathizes individuals. What I thought was that was really interesting. And my first thought was, how come he's referring to individuals and not shareholders like he's done in recent years? And I remember at the annual meeting, which was actually in 2022, but where, we were talking about the business from 2021, we were at that meeting in person. What Buffett was talking about at that time was ETFs and how some of the funds behind the ETFs, like the Vanguard fund, had a lot of power, because they're representing a lot of shareholders now. There's a lot of individuals that own ETFs. So Vanguard is a major shareholder in a lot of the S&P 500 businesses. And what Buffett was saying was that the Vanguard fund was really impacting these businesses and, coming in and saying, well, the shareholders want, for example, dividends, so please pay out a dividend, and kind of running the business of these S&P 500 businesses. So Buffett was talking a lot about that. So when I was reading this letter and read the very beginning, I thought, this is very interesting why he used the word individuals instead of shareholders. Is it because he really wants to signal that it's real people, it's individual investors, or what is he trying to say here?
Mm-hmm. That could very much be a good point of differentiating between people who are in funds compared to people who are holding Berkshire Hathaway stock for life, of saying, once you're in Berkshire Hathaway, you never sell, basically. Like there's no reason to go back and forth and, switch up stocks or funds just because you want to collect a dividend from them.
Absolutely. If we move on a little bit in the letter, in the first section, Buffett describes what we do. He describes that he and Charlie Munger, they got two ways in which they invest the Berkshire Hathaway savings. Either they acquire 100% of a business and become owners, fully owners of that company, or they buy shares in a publicly traded company. But what's important is that the mindset remains the same regardless of if they buy 100% of a business or if they buy shares in a company. They want to own the company forever.
Mm-hmm.
It's kind of the same mindset with the shares, that they're buying the shares to hold them for the long term. And as investors, we can learn a lot from that too. We also need to think about, okay, so even though we buy shares of a company or stocks, we're buying it with the intent to hold it forever, as if we were buying a company.
Yeah.
He writes, Charlie and I are not stock pickers, we're business pickers.
Yep, exactly. And I think that's a big emphasis that he wants to differentiate. I know he's talked about that in the past in other letters, of making sure we understand how Berkshire allocates capital. Of when they look for businesses, they want ones that ideally will be pretty decent performers. And I think at somewhere in the letter, he mentioned how, there are some with truly extraordinary economics and some that have very good economics. And there's also a large amount that are just marginal. So to me, I found that a little bit surprising that he kind of found that a lot of his investments are actually maybe not that great after all, even though he thought they would be good. And how, even though they would prefer owning whole businesses, sometimes you pay like way more for whole businesses because it's not usual that you can buy them on sale per se. So you end up having to pay a little bit extra if you want to own a business. But maybe that's why he thinks some of them have just been marginal performers, because maybe he felt like he paid too much for them in the beginning. And I also felt like he's been mentioning death and dying a few times in this letter. Of, earlier on when he talked about saving, he talked about when people died, their money will either go to their family or to philanthropic purposes. And here again, he talked about how there's been many businesses he's invested in that have died. So I kind of feel like there's a little bit of death on his mind in a sort of macabre way. It's a little spooky how much, if he's feeling like, toward the end of the line there, and he kind of just wants to acknowledge, what a full life he's been through, and how he's been in charge of Berkshire for a whopping 58 years, which is just an incredible milestone.
Yeah, I noticed that too about this letter, that it's as if it's a closing letter. I hope it's not. I hope we'll see many more letters from Warren Buffett. He did talk a lot about the end is almost coming near.
Mm-hmm.
I wanted to pick up on a few things you said here, Michelle. He mentioned that some of his businesses that he owned had done extraordinarily well, but he also mentioned that sometimes they make mistakes, that they have made many mistakes over the years. In the letter, he mentions US Air and Salomon Brothers that were big mistakes. Another one that comes to mind is Dexter Shoes. What likely happens when he buys into some of these mediocre companies, or some of the companies that doesn't do that well, is that he on the outside it looks like it's wonderful companies, and then once he start understanding more about the underlying business and the competitive landscape, he might found out that the initial investment decision wasn't that great. At least that's some of the things he's described also about acquiring Berkshire Hathaway, which probably was his biggest mistake, the textile mill in New England that now is a conglomerate. And he turned that around, his biggest fail, and turned that around and make it into his biggest win. And you also mentioned that, Michelle, that you buy shares in a company to find out more about that business, because it kind of energizes you and catapults you into learning more about that business. We don't know if Buffett does the same, or if that's what happens, but sometimes it seems like he's having that strategy as well. So you also mentioned the part about that sometimes stocks, they're cheaper to buy than businesses. And he writes, one advantage of our publicly traded segment is that episodically, it becomes easy to buy pieces of wonderful businesses at a wonderful price. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. And that's a really important point, because he writes that buying stock versus buying a whole business is an incredible advantage for us. It's very lucky, because my wallet wouldn't necessarily be to buy 100% of a company, but instead I can buy shares, and sometimes they're trading at foolish prices, low prices, instead of actually having to own a full company and putting time into that and money and capital, that instead you can buy a small portion and you can actually get that at a cheap price instead of having to buy a company. And as you mentioned earlier, you would have to pay significantly more to buy 100% of a business, because that's not usually on sale. To do it like that, that's usually more expensive.
Right. Yeah. And I mean, that's a awesome reinforcement that he's emphasizing buying wonderful businesses at wonderful prices. Either way, whether it's just pieces of it, like the shares of a publicly traded company, or wholly owned businesses that he calls controlled businesses. And yeah, and he also emphasized again in that paragraph, after what you said about both high and low, he said efficient markets exist only in textbooks. In truth, marketable stocks and bonds are baffling, their behavior usually understandable only in retrospect. So it's kind of funny how he's placing another dig at the efficient market hypothesis, where he I guess for posterity's sake, he just wants it to be on record again that he still never will go along with the academic view that in his mind, there will always be that manic depressive Mr. Market, like Ben Graham, his mentor, taught him about. And sometimes you do have opportunities when there's a lot of fear in the market. Like I think Berkshire Hathaway scooped up a lot of Taiwan Semiconductor at lower prices, and they may have offloaded some of it at higher prices. So they made like probably a decent profit on that one, even though I would have assumed that they were going to hold that equity position longer, but they've significantly reduced it, surprisingly. So it's interesting that he didn't talk about, from what I could tell, he didn't talk about anything he sold and why. So, since every now and then, if Buffett is reflecting on mistakes, sometimes he explains why he sold something, but maybe that kind of question will come up at the annual meeting. Hopefully, if whoever's lucky to get up on the booth to ask the question might bring it up. And if I get lucky, I might bring it up or come up with other fun questions to ask him. But I'm sure there's so much that we're wondering about, even just reading this letter, of the things that Buffett chooses to say and not say in this.
Yeah, absolutely. So if we move a little down the letter, he actually describes his secret sauce. And this is also why I think it's such a great letter for beginner investors, because after each section, he kind of sums up the lessons for investors. And in the secret sauce section, he mentions Coca-Cola and American Express, which is two companies that Warren Buffett and Charlie Munger invested in. And just in 2022 alone, Coca-Cola and Amex generated dividends of about $1 billion US, which is an insane amount of money. But what is also interesting is that these companies have grown between 17 and 20 times during that period that Berkshire Hathaway owned shares of these companies. And that's an annual increase of about 10% per year. So it just shows the power of investing in quality businesses and holding them for a long time. And also, of course, it's nice to get a chunk of change, sometimes the dividend from these investments that can provide additional income that you can reinvest. So yeah, absolutely amazing. And what Buffett says here is that, over time, it takes just a few winners to work wonders.
Right. Yeah, and also just getting those dividends on their original cost basis, they've already paid for their original investment many times over. So now this is just kind of like getting free money from some initial investment from that they finished doing in the 90s. And the beauty of that is being able to collect that cash flow and then use that for other purposes. So I know a lot of people love dividend stocks for reasons like that. Like they like getting that check. And even though a lot of us don't get a physical check anymore, it just gets deposited in our brokerage accounts and then we can do whatever with that money. But a lot of people do enjoy getting that. So it's pretty cool when you can just have a free asset essentially that will keep paying you money forever. And it's kind of nice that, that to your point about quality businesses, you wouldn't necessarily get that lucky with other stuff. Like he makes the comparison with, treasury bonds of if you had made a similar investment in just bonds from the US government, it would have been a disappointing investment, he said, that would have only grown to a very small fraction of Berkshire's net worth compared to the about 5% of Berkshire's net worth with Amex and Coke. And so that would only give them a very small amount of, like, say, comparable interest or dividends compared to the billion or so from the two of those investments. So comparing, say, 80 million from just a bond to equities giving you, like 1 billion, I think. Yeah, about 1 billion in total with the 700 million from Coke and the 300 million from Amex. Like, it just shows that bonds generally pale in comparison to the value you can get from equities. So it's just another lesson of how time and time again, we more so want to invest in equities if we can. Like bonds can be a little bit of okay if you get an almost competitive rate of return, but over decades, it's just reinforcing how hands down almost nothing beats investing in the stock market, aside from maybe if you actually own your own business and you can fully control how you generate returns through your business. That might be even better. But the next best thing are the stock market if you don't have your own business to generate your own income from.
Buffett also mentions a little bit later in the letter, he mentions American Express again, because he mentions how repurchasing shares actually increases our ownership in the company. So if a business starts repurchasing their own shares, then our share of that company grows bigger. And he says that it's in no cost to us. We just own more shares. And he's got this section where he explains stock repurchases. And it's also a very, very important lesson for us. If a company repurchases their own shares, then we own more of that company. And if they don't reissue those shares, it's a really, really great deal for us as investors. Over time, we own more and more of that business. So that's another way where Berkshire Hathaway owns more and more of American Express over the years without actually, having done anything or put more money into that investment.
Yeah, it's like your share of this business pie gets bigger instead of smaller. So when companies issue shares, like you said, like whether it's for employee stock options or they need to raise capital, that dilutes it and makes your share of the pie smaller. But when they retire shares by repurchasing them, or it's also called stock buybacks, our share gets even bigger. So both Berkshire and Apple and Amex have done those things that have made them more valuable. And I think he talks a little bit more about share repurchases, but maybe we should hold on to some of the thoughts we might have on some of that, because there's definitely more that I know I would want to say about what his reflections are about stock buybacks. But I think that's a really rich topic that maybe it would be good to save that for next time and also resume continuing our analysis on this letter in this section, the past year in brief. What do you think?
Yeah, I definitely think it's a good idea to pick up on that topic, because there's so much to be said about repurchasing shares. So I totally agree that that should be a topic we need to bring up. We're coming to an end, but one thing I want to say about this annual letter, and I think, we could continue to talk about this letter, but one thing I wanted to mention is actually the last paragraph where it says, nothing beats having a great partner. And Michelle, I'm really, really grateful to have you and, to have met you. And I really enjoy making this podcast with you. Collaborating with you is super fun. And it also helps me to grow and learn. So I'm so lucky that I have found a great partner in you, is what I came to think about with that.
Oh, and I'm so grateful to be podcast partners with you too, Signe. And it's been a blast and such a joy to work on this together with you, because we're both so passionate about Warren Buffett and Charlie Munger's style of investing. And I think it works incredibly well, like how Buffett was just glowing about his partner, Charlie, and he talks about Charlie a lot. So I think that's just an amazing thing if we're able to find that in our lives. And I highly encourage folks that, if you want to grow as an investor, you should surround yourself with other people who you think are good investors or have good insights like Signe does, because that helps us grow and expand our horizons. And I'm just so thankful for you too. So that's just awesome. Thank you for saying that.
So with that, we're going to end the show for this time, but we will see you on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts, so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.